It's Brian Preston, the Money Guy.
So let's talk about what predictions, because remember, the headline or title for our entire show is How to Make Money Through Predictions. So let's actually give some love to where predictions do offer value with your investing. So what predictions can you count on, or how do you read the tea leaves? Let's give them some love on this.
Yeah, so I think the very first thing that we said, if you want to think about reading the tea leaves and predicting the future, first you have to kind of think about where you are. And this is our opinion. If you're in the early stages of building assets, in the early stages of building wealth, the way that you should think about reading the tea leaves, if your investable net worth is less than around $400,000, is don't do it.
Don't even consider it.
Don't try to read the tea leaves. There are fantastic solutions out there like target retirement funds where you don't have to figure out which way the market's doing and how much I've allocated. All you have to really think about are two things. How much do I want to be saving, and when do I want to be financially independent? When do I want to retire?
The component of saving, the behavior of saving, is so much more important than all the other noise that's out there. So, because remember, in the beginning, you're trying to build this automation or addiction to building assets. The saving, what you're putting in is so much more important than where you're putting it. So put it in something like a target retirement fund. So you set it, forget it, and then don't let the predictions game happen later when you require a little more sophistication.
That's exactly right. So we think that once your portfolio graduates past the point of where target retirement fund or a solution like that might make sense, now you might want to start thinking big picture, looking at some big macro type trends.
Yeah, and when I think about macro trends, like people always ask me because they're thinking about retiring or other things like, how is this going to work? I'm always worried about, is there a risk that we hit a downturn right as I'm thinking about it? And I do think that's smart. You got to think about where we are in the market cycle. So you might want to look at price to earnings ratios of general markets and so forth. You could also think about, there's big things that happen through innovation. Since we're bragging about how great it is, and in a minute we'll talk about innovation, think about the fact of Amazon. So many of us have all these smiling boxes showing up. What's the impact on our local malls? What's the impact of all the overnight delivery services now that they're delivering more and more stuff themselves? Those are type of macro trends, but that's still not even economic. So, I mean, that's stuff that you want to think about because it might have an impact on real estate and other parts of your sector plays. But overall, I don't even know if that stuff sidetracks me.
No, not at all. It's all about small tweaks around the edges. You have to get the big picture right, and then it's not a function of timing in the market or timing out of the market. It's how you design the individual slices. Just like you said, Amazon effect, or, we talked about this back in 2011 as interest rates were dropping. We said, hey, maybe we ought to think about the way we should look at thinking about the fixed income part of our portfolio in a rising rate environment as opposed to in a declining rate environment. You make changes around the edges, not am I all in, am I invested, or am I in cash sitting on the sidelines?
Yeah, I mean, it's one of those things. Definitely focus on things you can control, also understanding what is an efficient market, what's an inefficient market. And then look, if you realize that you've built enough level of success that you're scared of making a mistake, that you're worried about putting it all in the ditch, don't be scared to ask a professional to kind of help you out, especially a professional that's like-minded, that's honest enough to tell you, hey, I'm not going to beat the market. I'm going to actually match the market, but I'm going to make sure that we have the right assets in the market. We also going to have enough assets in conservative things. That's the important stuff, because financial advisors are not supposed to help you beat markets. They're supposed to help you develop a plan of action that gives you the best course of action for retiring when you want to, reaching your financial goals, and also interpreting all the things like risk, age, and all the things that go into a successful financial plan.
So as you think about this, right, as you think about what, reading the tea leaves, and there's so much stuff that you can't count on, like news media and economists and that sort of thing. Brian, what's something that we can count on as we think about investing and being a participant in the investment markets?
Well, I always because investing, it's one of those things where I think people think about markets in terms of, I think they think of them as one big pizza pie. And they just don't know that somebody doesn't have to lose money for you to make money. There's always innovation. There's always a growing market cap. So I wanted to kind of put some illustrations. There was a time when we used to do a lot of research, just me and you, trying to put together graphs. And we thought it'd be a great thing if we could show clients, if we could show prospects, that just if you put together a very simple generalized portfolio of a 60% S&P 500, 40% bond portfolio, how just time in the market. It's that whole concept. If you just understand that you can believe in the market, the growing pizza pie through innovations, globalization, all the cool things that make it great to be alive right now. What does that look like? And should you just stay the course and put time in the market, not trying to do the timing in the market as we talked about?
So this illustration we're about to share with you, if you're someone out there listening on iTunes, listening on iHeartRadio, look down at your device, note where we are in the show, because you're going to want to go to YouTube and check this out, because these charts really, really are powerful, and I think you're going to dig it. So what we said is if we look at a 60-40 portfolio, and we just look at annual returns, and we went back to 1953 all the way through the end of 2018, and we just wanted to do a scatter plot of the returns. Okay, what did it do in 1995? What was it in 1992? What was it in 2002? And then if we look at all the one-year returns, what's the average over that 65-year period? And we found that the average was about 9.51% if you just look at a 60-40 portfolio over that 65.
I feel like I'm a baseball announcer and I have to give some visual things so that the people who are listening on their podcast, working out, guys, I'll just go ahead and tell you, even though it's an average of 9.5% from 1953 to 2018, this thing looks like you're herding cats. I mean, you could throw darts at a board and have some more consistency than this, because the numbers are all over the place, because this is looking at every 1 year period with the annual performance of this 60-40 split portfolio. But I do want to tell you one thing that's kind of optimistic. This is 65 years. If you do the math, 1953 to end of 2018, that's 65 years. There's only 11 years that it went below zero. So there's only 11 negative years out of this 65-year period. That's pretty exciting if you think about that from a statistical standpoint.
We didn't do this math, Brent. I bet there were more than 11 headlines over that 65-year period that suggested the markets were going to go down.
You saw on that previous slide, there are so many negative headlines, and they use it's almost like, you know how you shake the magic 8 ball?
Oh, yeah.
And it gives you, a prediction of some sort. I think journalists shake a magic headline creator and it says double dip recession, or because I sometimes on Twitter, just like 3 days ago, I posted on Twitter, said stock slide on some announcement. The market was down 16 points or 0.1%. It didn't even equal 0.5%.
That's not a very big slide.
So it's just ridiculous. So in the short term, just know, like I said, if I'm a color commentator on what you're seeing in the baseball game, the average performance on a year-to-year basis over 65 years on a 60-40 portfolio is 9.5%, but it looks like you're herding cats with 11 years below water.
So what we said, Brian, is, okay, that doesn't look like there's any sort of discernible pattern, discernible thing going on here. So what happens if we look at this exact same data, but instead of looking at it on a 1 year by 1 year basis, we look at it on a 3 year basis? So now instead of looking at each year in isolation, we take 3 years and we average out the return on a 3 year rolling basis. And this is what we saw. The average stayed pretty consistent. The average 3 year return from 1953 through the end of 2018, 9.13%.
What I like about this, what is the first thing we talk to people about investing? If you tell me you need to have money for a house down payment next year, or you're buying an engagement ring in 3 months, I'm going to tell you, you don't need to put money in the markets unless you can give me 5 to 7 years. Long-term investment is what goes in the financial markets. So already just by going from a 1 year basis to a 3 year return, meaning you stayed the course for 3 years with this 60-40 split, long-term performance didn't really change much. But I want you guys to know the visual of this is completely different. Now, out of the 65-year period, there's only 3 rolling year periods that the market was actually negative. So if you just stayed invested for 3 years, there's only 3 periods, 3 dots that would have been negative over that 65-year period.
Just for some color commentary, I think it's interesting. Those 3 dots were 1974, 1975, and 2002. Not even 2008, which you would have assumed it would have been. So then we said, okay, well, you just said, Brian, if you want to be a long-term investor, you really need to be thinking about 5-year chunks, not even 3-year chunks. We said, okay, again, what if we look at this exact same data, but look at 5-year rolling periods instead of 3-year? Again, the average rate of return was very, very consistent. It was 9.07%.
Now, the good news is not a single year went negative. So as long as you stayed in the market for 5 years, it was positive. And we're also, I will tell you, back in the early 2000s, there were these posters that if you squinted just the right, they made like 3D designs that you could see in them. we're starting to see after 5 years of investment that herding cats where it's like looks like a dart board where annual performance is always placed. It's starting to look like if I squint just right, Bo, it starts to look like a line is forming there to show a trend.
You just brought something up so nostalgic in me. I hadn't thought about those things since like
It was actually the 90s. I shouldn't say it's not the 2000s, it was the 90s because we had them in college.
It was mind blowing. I remember that. We got to talk about that after the show.
That's
'cause
going
you just
on in
took
the
me back.
market right there. You can see it in the data if you had the visual.
So now, if we say, okay, what if we think about less about like even 5 terms, like the beginning of long term? Let's think about what if we look at 10 years,
Yep.
10-year rolling periods from 1953 to 2018.
Wow, that is really tightening up.
The average return 8.98%, and dare I say, I can actually see a pattern here. I
Yeah.
can actually see a picture really starting to form.
That
now.
is a market cycle. I mean, if you look at this is a market cycle. So it really determines on how not do you make money? Because if you just stay in the market for 5 years, you know historically you would have made money.
Yep.
This just shows how you maximize where's the opportunity on in the market cycle, the economic cycle that you're investing into. So that's 10 years, looks really good.
And so then we said, okay, what if we think about, a working career? What if we look out 20 years? How does it change the number? On 20-year rolling averages from 1953 through the end of 2018, the average 20-year rolling average is 9.36%.
Guys, it's amazing. We used years. We typed in each of those, but it looks like a line. When you see this visual, it looks like a market cycle line. So there is an ebb and a flow, but it's all bobbing up and down below and above that 9.3% average.
So what's the takeaway here is that your perspective matters. If you're looking at investing and looking at your portfolios, oh my goodness, how am I doing this quarter? How am I doing this year? Should I get in? Should I get out? You're probably missing the big picture. If you can think about long term, what am I ultimately doing by putting my army of dollar bills to work for me? This will let you see that it's not throwing darts at a dartboard. It is a consistent, just like you said, steady walk up the mountain with a yo-yo.